Hi, my name is Scott Dahl. I'm an investment advisor. I'm in San Juan Capistrano, California, and I'd like to welcome you to my first podcast, and first of what I hope will be many. What I'm going to do is talk about the markets. I'll talk about how I invest, and then I'll give you an idea of what I think is going to happen in the future in the stock market and bond market for that matter as well. And so this will build on itself, the description of how you make investment decisions, how you read price, which is very important because that's the only thing you can really invest in is the price of an asset or the price of a stock. I'm going to use the term stock and I'll use the term equities. We'll focus on stocks. What I'm going to talk about could easily lend itself and does lend itself to other types of financial markets. So I'll do a few of these, two or three of these that will get us to the point of where I can give you an idea of what I think is going to happen, and then eventually I'll bring in some outside guests and do some fun in other areas that I have interest in. So with all that said, I'm going to get into what I do for my clients, and how I make investment decisions. So I have my own registered investment advisory. The name is Dahl Capital Advisors Incorporated, and that's DOLL, and then capital CAPITAL. Advisors with an O. I've had my own company since 1996, but I've been in the industry for a much longer time. I actually got securities license back in 1983, so I've been securities licensed for a little over 40 years. And what I do is I help people invest their money, and with the objective of helping them meet their goals. Let's talk a little bit about my background. I started following prices of assets back in right around 1976. I grew up in a small town in northern Indiana. I was a basketball player. I also played collegiate basketball eventually. And in the summertime, when I wasn't playing basketball or I wasn't working, what I would do is I would go over to a commodity futures office, which was about 30 minutes from where I lived, and I could watch the prices of the commodities, gold, silver, pork bellies, soybeans. I could watch it trade on what was called a clacker board. It was a large black rectangular board, and the prices would move as the trades happened. There was a feed from Chicago and then from New York to Chicago and down through a phone line. This was back before we had computers, or before we used computers of any kind. So I would watch the prices move, and eventually I started meeting the people, the brokers and the traders, a lot of farmers that would come in during the day to watch their corn go up or down that they had in the silo. And they would teach me how to draw charts. So this was the first time that I started drawing my own charts. And you didn't have computers back then to create your charts, so you hand drew them. And a lot of the old technical analysts, of which I am one, I'll explain that, they said, hey, you need to draw your own charts in order to really truly understand the price movements. You have to have a tactile, personal feel with it and to it. So I would draw my charts, and I would try to use these charts to determine what could happen in the future of price. Now, I never really got away from this. It was always very interesting to me. And when I got out of school, out of college, and I went to the College of Charleston in South Carolina. When I got out of school, I got a job as a commodity futures broker, and then very quickly got securities license so I could do stocks as well, stocks and bonds. So I am a technical analyst. That's my specialization. That's how I make investment decisions, and I'm going to define that and explain what it is. I am a chartered market technician. It's offered by the Chartered Market Technician Association in New York, and the acronym is CMT. I was the 291st person to achieve this designation back in 2001, and it was a very intense self-study process over a 3-year period. And it was relatively easy for me because I liked it. I really enjoyed learning this. So I was 291st person to achieve it. There's currently, I would estimate, somewhere between 4,000 to 5,000 chartered market technicians, CMTs, globally. So it's the premier accreditation. It's the highest achievement. Not only do you have to pass these rigorous testing levels over a 3-year period, you also have to have a peer review. I had to present my work to people in the association. They had to recommend me. I also had to have some tenure in the business. So it was really a very rigorous, but a very, very rewarding process. So this furthered my education in technical analysis when it comes to analyzing the markets. And it was nice because it was a structured set curriculum by these people who had been in it for years, and some of them unfortunately are not around. I mean, it was a while back, but it was so nice to have that structure. I felt so fortunate to find that. That's what I do, and that's my expertise, is reading charts, reading price movement, and I'm going to explain it. So let's talk about my business and my clientele. So I have a very select clientele. I don't just work with anybody, and there's reasons for that. Number one is we have to like each other, and it's got to be a nice person that I'm working with, which makes the job a pleasure. Also, we have to have similar philosophical values when it comes to money. That's important. We have to have a good communication, a good communicative relationship, because if you don't have that, and you have to have trust. If you don't have those two things, it impedes the progress and the performance and what I can actually do for the client. So what I do when I meet a prospective client is we sit down, and first we have a discussion, and we get a feel for each other and see if there's good potential for a fit. If there is, then what I'll do is I'll review the assets, and eventually I will either realign their existing portfolio to hopefully meet their goals, or I will design a new portfolio, again, structured to meet the client's intermediate, short, intermediate, and long-term goals. So it takes a really in-depth analysis of the client. I need to know what their risk tolerance is, again, what their goals are. Do they want to educate their kids or their grandkids? Do they want to leave money to their family? Do they want to leave money to charity? When do they want to retire? What do they want to accomplish in retirement? What do they want to accomplish in life? What do they want? Do you want a second home? Do you want to travel? So that's what we need to do is determine what the person's goals are. Then we can build that investment portfolio to achieve it. So a lot goes into the initial discussions. Then I look at the assets. And then we go ahead and we talk about it. We figure out what we want to do. Another reason why I keep such a select clientele is because I don't want to be stretched too thin. I want to make sure that I can give the maximum amount of effort to each and every client that I have. And that means continuous contact. I talk to clients on a very frequent basis. I'm always an open door. If they need anything or anything changes, I need to know about it. And I will typically have quarterly appointments with virtually everyone. So it's a small clientele, but I'm really dedicated to the client's success. I take a lot of pride in it, and it's very emotionally gratifying to know that I'm able to help somebody in life and enjoy life. So that's my objective. Back to technical analysis. I'm going to use the term equity and stock interchangeably. You can analyze a lot of different markets, bonds, currencies, but I'm going to focus on stock analysis just for congruency. And we can also talk about other markets at any time throughout this process. So there's two basic schools of analysis when it comes to the market, and they've been around hundreds and hundreds of years. They're both important. You need to be able to intertwine the both in order to hope to have a successful investment process. So the first would be fundamental analysis, and the reason I'm starting with this is because fundamental analysis has been probably the most dominant form of analysis on Wall Street or in the investment world for a long period of time. Technical analysis has always been there, but technical analysis it seemed like it was always very important, but it seems like it really came up on the forefront back in 2000 when we had a market collapse. And that's when it seemed to become more and more important. And it's always been important to me, but I was glad to see that this discipline, this analytical discipline of the markets was finally being recognized for as significant as it is. So I'm going to go down to and first talk about fundamental analysis. A fundamental analyst focuses on economic forces of supply and demand that cause prices to move higher, lower, or stay the same. So it's the cause of the price movement. What would cause the price movement, let's say, of an individual company? A fundamental analyst would look at the product or the service of the company. They would look at the demand for the product and the service of the company. They might look at competition in that particular space, the company's competitive advantage. They would look at perhaps the company's management to see if there's sound management. They would look at the company's financials to see if they had, say, plenty of cash, if they were solvent, if they were a very stable company. They would also look at where they would fit in the current economic environment. It takes in all these fundamental elements, and then the fundamental analysts would combine it together, and they would use this data that they have, or this analysis, and they would determine whether a particular stock or market, for that matter, is too high or too low, or if it's really not worth investing in. And then that helps them decide whether to recommend that you buy or you sell a particular stock. However, a technical analyst, which is my concentration or my specialization, a technical analyst concentrates on the study of the market action, mainly the price movement of the asset, the movement itself. The reason that price movement is so incredibly important is because that's how you make money. You buy an asset at a certain price, and if you're lucky, if you've done your homework, you can sell that asset at a higher price and make money. If the asset goes down, you sell it at a lower price and you would lose money. But the importance is it's the movement of the price of the stock or the market itself that either puts money in your pocket or takes it away. If you study price, past history of price of something, the day-to-day movement, or it can be a minute-by-minute movement, or it can be a 200-year movement. But by studying these prices, you have everything that has happened on a fundamental basis in that particular stock is represented in this graphical pictorial of that stock. Everything that's happened, anything economically, geopolitically, fundamentally that's happened to that company is represented in the price of that stock. If you study the past data, the past price of a particular stock or the market, you will recognize repetitive patterns. Now, here's the crux of technical analysis, the actual study of price, is the stock market is a psychological mass. Sure that these stocks represent companies, but it's still the stocks, the price is what everybody that is buying or selling that particular stock or market thinks that it's worth at that specific point in time. It's a conglomeration of all the buyers and sellers that have come in at that specific instant to create that price. So it's a psychological mass, and we as human beings have a tendency to repeat ourselves, and we have throughout history. And Mark Twain said, "History doesn't repeat itself; it rhymes," and it truly does. And so, if you can see these repetitive patterns, be them long term or short term, in price movement, and I'm simplifying, I'm just focusing on the price. There are a lot of other tools to go into this, but if you can see these repetitive patterns, then you have a chance of perhaps having a leg up on the competition. So what creates this repetition in price? Well, what creates this flow or this repetitive pattern in price movement is because of human emotion. When stocks or the market is at the top, that's when the news is the best. So that's when it's human nature to want to buy because things just feel so good. They're so good in the news. And when stocks or the market is at its bottom, things look the worst. That's when the news is the worst. And then people they sell at the bottom. So they buy the top and they sell the bottom repetitively. In fact, there's been studies done. I know Dalbar, for one, has done studies showing that the average investor, unless they're working with a qualified investment advisor, they will underperform the market in their investment efforts. And the reason that they underperform is because they let their emotions get a hold of them and they do the wrong thing at the wrong time. So I always tell my clients, if you're working with me, I want you to be successful. That is my primary objective, obviously, and I take pride in helping you get there. However, your money is not mine. It's yours. And what I do is I'm an insulator. I don't have an emotional tie to my client's money. And so I can help make the correct decisions at the correct time because I've seen these overvalued and these undervalued periods in time. And I know what the best course of action is at these certain points. So that's why if you're working with somebody that is qualified, they'll help you. You'll stand a better chance statistically, it's been proven of making money in the market. So you don't let your emotions take over for you. And if you look at the human nature, we have a primordial need to herd. And what I mean by that is, say you take a herd of elk, for example, and one elk spots some danger and takes off running, and the other herd thinks, well, there must be danger, so we go as well. So we as humans have this same desire to herd, and we think if the market or other participants in the market are selling, well, we better sell too, because they probably know something that we don't, and we want to make sure we avoid the risk. And that's the same on the upside. I mean, if the market starts to go up and this greed takes over, and we don't want to miss out, we want to make money if our neighbor's making money, so we pile in and if the markets are moving higher, if they're making new highs or they're going higher, I'm not saying that's a bad thing or a bad time to invest, but you really want to buy when nobody else wants it. That helps your investment success significantly. So not only do we have a tendency to herd, but we have a tendency to at the top of markets, it's the fear of missing out. It's great news. You want to buy, and then at the bottom, you just have this overriding urge to sell because of this negative pull that's all over the news, and that's a sure way to underperform. I'm going to give you an analogy of how people have a tendency to invest, and the stock market is the only place that you can go where if things go on sale, people don't buy. An example that I like to use is, say you're walking down past a storefront, you look through the glass and you see a pair of shoes that you really want to own, but they're too expensive. So you go home at night and you think about it, and you wake up in the morning, you think, you know what, I deserve it. I'm going to go buy that pair of shoes. So you go back to the store, and you see in the window that those shoes have been marked down to half price. So what you do is you buy two pair. Well, that's not how the market works. At the top of the market, people think it's so great that they go ahead and buy. But when at the bottom of the market, when things look really bad because emotion takes over, you don't buy. So you should be doubling or buying more down at the bottom, just like you would if you were to buy an article of clothing or any type of item like that. So to sum up my point, the fluctuation in the stock market, these peaks and valleys, it's not normal economic forces at play, because the buying is accentuated when prices are high, and the buying drops precipitously when prices are low. So it's not a normal economic relationship. It's actually the inverse. The market is predicated by human emotions of greed and fear. It's fear at the top, and the reason the tops are so sharp is there's a big bunch of greed that goes in, and then at the top of the market, when it breaks, it starts to sell off. Selling sort of perpetuates because people are scared, and fear is a stronger emotion than greed. So tops are created very quickly and very sharp. But at the bottom, it's greed, but greed takes a while to take hold because the news is so incredibly bad. So that's why bottoms are kind of bounce along for a while, and then they start going up again, is because you have to get that you have to stir or ignite that greed emotion in the market participants, so in order to get it going again. And we see this over and over and over. These are repetitive cycles. So a pure technical analyst is not really concerned with what's making the price move. They're concerned with the movement of the price, and by analyzing the movement of the price. And another quote I'll throw you is Goethe said, I'd prefer to err on the side of the minority because the minority is usually correct. So what I take that to mean is the majority of the market participants or investors are usually doing the wrong thing at the wrong time because they've been gripped by emotion. What I'm going to do is I'm, again, going to focus on price. There's a lot more that goes into technical analysis. However, price is the way that you either make or lose money by buying or selling the price of an asset. So we're going to start at the basics and look at that. So what you see up there is you see a chart of the Dow Jones Industrial Average. It's 30 stocks, and it was created by Charles Dow back in the late 1800s. And what he did is he put 30 stocks together. A lot of it were railroads at the time. And he put 30 stocks together that he felt would be representative of the investing public's portfolio, because you had to have something to watch to determine what the overall trend of the market was. So there were indices prior to this one, like the Cowles Index, which was a railroad index that went back to the mid-1800s. But Dow formalized it, and this is what he created. And now the 30 stocks in there, they've changed over time. It's no longer a railroad-dominated stock average, but it's 30 stocks that even though Charles Dow is long deceased, that Dow Jones still feels is representative of the average investor's portfolio. So what you're looking at is a daily chart of the Dow Jones Industrials. The right axis is price. And here's 28,500, 36,500. So that's the price of the index. Now along the bottom is the date. Now I just picked this just because I thought it was a good example for no specific reason other than that, but you can see that you have August, this is 2022, you have August, September, October, you see 2022, and then you have 2023, pretty much close to where we are right now. It's a couple days old, but that's where this data comes from, this specific point in time. Now, you can do charts for a day, you can do charts for a week, you can do charts for a month, you can do charts for years. You have all different time frames available, but what I'm showing you right now is a daily chart. This is a daily chart of the Dow Jones Industrial Average. So, for example, this green line right here, that represents 1 day of activity. That's a one specific day in August of 2022. This is color-coded. I like to use color-coded. A green is an up day and a red is a down day. What this is an uptrend in the Dow Jones Industrial Average. That's what you're looking at over a period of about 13 months. And so it would be considered an uptrend, or it could be considered a bull trend. And what makes this a bull trend? Well, it's simply higher lows followed by higher highs. Here's what I mean by that. So you have a high, you have a low, you have a higher high, you have a low, you have a higher high, and you have a low. I can draw a trend line. When you have an up move, you draw the trend line across the bottom because it's going up. So I have this trend line from here up through here. And what would change this bull market, what would change this bull move would be if it were to break this trend line and then start putting in a process of lower lows followed by lower highs. This is also a chart of the Dow Jones Industrial Average, and this is a little bit of a different time frame for no reason other than it's for explanatory purposes, and this has got a little bit of twist at the end that I'm going to explain to you. So you can see this is January of 2022, and this is January of 2023. So we have, about 13 or 14 months of data here. And this is a downtrend or a bear phase. So how does this differ from what we just looked at? Well, you've got a high, you've got a lower low, you've got a lower high, you've got a lower low, you've got kind of a lower, you don't have a lower high, but there's not a whole lot of activity up here. So I would say that's a lower high. I just want to pause and say that the thing about technical analysis and why it's art, it's science, but it's art. So two people could look at a same chart that are experienced and see entirely different things. That's what helps make the market. So let's get back to it. High and followed by a lower low, and then another lower high and an even lower low. This is a downtrend. So we had an uptrend. Now we have a downtrend. And I can draw a trend line across these points, and that gives me my downtrend. So when is this no longer a downtrend? Well, it's no longer a downtrend when it breaks through this trend line and makes a higher high. This is a higher high followed by a higher low. Lower high. Here we go again. So that's part of the art, is just determining whether it's time to get in for a new move higher or whether this might fail, which it did in this particular example, and will resume in this downtrend. So that's a challenging part of technical analysis. So we had uptrend, we had downtrend. Now I'm going to show you the third and only possible trend left So this is a sideways trend, and this is a little bit different from the first two charts that I had shown you. The difference in this chart, and again, for no particular reason other than for explanatory purposes, I thought it was a good visual representation. So each one of those bars, rather, is not a day anymore, they're a month. So we have a lot more data here. You can see we have a significantly higher spread in price, and we have a lot of years. So these are not just months, they're years. Why did I select this? Because it's such a nice example of a sideways trend. So not a bull, not a bear, it's going sideways. So you've got three trends. You've got the uptrend, you've got the downtrend. We all like the uptrend, most of us. And then you've got the sideways trend. So a sideways trend is, it doesn't have one line to identify the trend. It has two. It has one on the top and one on the bottom. And you can see you've got a peak here, down, a peak here, down, a peak here, down. Here it made a new low, but then it comes back up. So it keeps hitting these peaks. And I'm going to explain in the next episode what these peaks are and how do you define these peaks and how do you use these peaks in your favor to make money in the market. And so this is a sideways trend, went on for years, and so those are our three trends. And that's what I wanted to show you today. So if there's any questions, you're more than free to call me or contact me. My phone number is 949-497-6366. Again, 949-497-6366. Dahl Capital Advisors, DOLL, Capital, CAPITAL, Advisors with an O. You can Google Scott Dahl Investments, Scott Dahl, San Juan Capistrano. You can also email me if you'd like at scott@dahlcapitaladvisors.com. So I'm going to continue to do these. The next one, we're going to look at support and resistance. I'm going to define that for you, and then I'm going to get into the nitty-gritty of what I think is going to happen here going forward. Then we'll have some fun. I'll bring some guests on, maybe some clients, people of interest that may have to do with music, something entirely different than the market. And again, thank you very much, and look forward to this, and I hope you will as well, and I hope you continue to join me on these. Thank you.